Be here.
Let's talk about that massive gap between markets and what the Federal Reserve seems to be implying, what their plans are for 2024. Everyone's weighed in on how we're going to reconcile things. How do you think we will?
So starting the year, it seemed like you could at best get only 2 out of 3. You could have unemployment below 4, growth in the U.S. in the mid-ones, and 6 rate cuts. So it was trying to square that, and that's against a backdrop of a deficit of 5 to 6%. So it just didn't seem to make sense. And then you had a melt up into this belief. So now we're having a walk back. You know, if it was close to 80% in the beginning of the year, now it's 60%. There's a walk back. I think we're probably halfway through the walk back. So I think there's more to go, but you certainly have the easy move right now.
You wonder where that leaves markets. Equities close to all-time highs. Credit spreads still pretty tight when you look at high yield on any given day.
You know what? On the credit spreads, I'm fine with them. In terms of single B, double B, you're still getting pretty good value. One of the ways I like to think of value is what's your spread versus expected default. And at 350 and 7 3/4, given what we expect for the default rate, you're still getting around, call it 200 basis points of excess yield. So I think you could be 50 to 75 tighter in a more benign environment. So the absolute spreads don't concern me.
So basically you're talking about how people are saying the biggest risk is that the Fed isn't going to cut rates as much as people expect. You would disagree, and you would say it's that the economy turns down, and that would be a bigger risk. Am I taking that a bridge too far?
A little bit, because there's always stuff to do. But right now it was priced nirvana, perfect environment. So if the economy slows down, there'll be winners and losers. But right now, particularly ending the year with the melt up, there's just too much broad optimism.
Well, when you talk about the broad optimism, everyone who we talk to here has been talking about alternatives, private credit. John did a whole forum on how everybody wants to get into private credit and the expansion of this field. You've been dealing in markets that are less liquid for a long time. Does it concern you that everyone's piling in without necessarily the same kind of quality checks that you might get in a public, more transparent market?
So the short answer is yes. The short answer is yes. And the historical returns that you've gotten, around 300 basis points of excess return, I'm skeptical you're going to get that in the future. In terms of what is private credit, first is, it used to be smaller companies called enterprise values of less than $1 billion, $500 million. That's actually expanded. When we look at our private credit book, it's about $500 million of EBITDA, enterprise values of, call it, $3 to $5 to $10 billion. So it's a much larger market. It's when you look at who issues private credit, it's private equity is the largest issuer, and the idea that they're going to leave 300 excess basis points on the table, long term just doesn't seem to. It's nonsensical. So we don't expect that to last. And also there's a lot of competition. Now, when we look at our private credit returns, we had a great year last year. We're seeing interesting stuff. You're going to be solution providers, providing acquisition financing, providing asset liability financing or liability management financing. So I think there's certainly needs for it. It's where the most innovation in credit is right now. It's a really important point that when you look at like a structured products in the 90s, there was a lot of innovation. Right now, private credit has a lot of innovation. But generically, the excess return, I'd be surprised if the next 5 years resembles anything like the last 10 years.
Solution providers, let's build on that. You're a solution provider if you buy AT1s, and you were last year. It felt like that market might have been killed off by Swiss authorities. You took a different view, a contrarian bet. It paid off big time. Can we just start there before we talk about contrarian bets for 2024?
Sure.
What did you see that maybe others didn't?
It's simplistically, the AT1 market's vital. Having owned banks, and we've owned a couple banks where we've been large equity holders, it's of private banks. It's a really important financing alternative. And particularly when you have situations which are precarious and you don't necessarily want to put down more equity, having a hybrid security is a really valuable alternative. So the idea of, if you of eliminating that and having the hybrid security actually be hedge you lose and tails I win type of investment, because if it doesn't work, you get the same downside, and if it doesn't work, you have no protection. And if it does work, your upside is less. Doesn't seem like a good alternative for the regulators. So our view was simple. Simple names are already working. This market's going to come back. The regulators, and we had a strong view since we've had a couple of these banks that have already been regulated, that they are very much in favor of having a lot of choices. So we felt that was a relatively easy trade. In fact, what I felt my biggest mistake was thinking it might last longer than it did.
It sounds easy now, looking back at the time. It was not easy. I think, Lisa, you and I were talking about this at the time. It felt like maybe we'd see a real loss of faith in some of these products, these securities.
I just remember just seeing the valuation tank.
Big time.
So it sort of goes to the whole idea of easy money being made. It's really easy to say that in retrospect.
There's nothing easy about this.
So one of the interesting things, this was against a backdrop where the return on equity of European financial stocks was going to be the best it's been in easily since 08, since the crisis. So that was also another nonsensical. So you have really good earnings. The profitability, whether it's through cleaning up the balance sheets, we saw that during the pandemic, there were excess charge-offs, to being levered to higher rates. So the return on equity had gone from, call it, if you look at the SX70, had gone from, call it, the mid-single digits to the double digits. And then the AT1s weren't going to work. That just didn't seem to me fundamentally to make sense. Or maybe to put it a different way, I've never seen that happen in my career, where the junior securities haven't done well when the underlying profitability is improving.
So is there anything else that's like that right now? Just you can tell us. There's nobody watching.
The easy money for 2024.
Exactly, please. Thank you.
You know what? I do think the single B, strong single B, double B is very reasonable. I think the preferred market, so when you look at DirecTV just did a deal in the high 400s, I think that's reasonable. You look at a Valeris, an oil service company, reasonable. So I think that there's a whole bunch of names that are caught in the high single digits, loan to value of below 50%, that I think are very reasonable compared to equity values. You look at the preferred stocks, also very reasonable. Some of the larger issuers that are trading around 9–10%.
Do you think that credit is going to materially outperform equity this year and has the potential to for a prolonged period of time?
It usually does early in a cycle, with the pandemic being the one exception. If you look at the past few cycles, I think it's certainly a reasonable asset class still. When you look at, it's a higher quality asset class than it's ever been in terms of the mix of double Bs versus triple Cs and single Bs. And you're getting, the index is yielding about 8%. So that's not to say you won't get better opportunities, but as a entry point, I think it's a reasonable entry point.
Steve, everyone in Davos has been talking about the elephant in the room, which is the former president potentially coming back into power. How are you thinking about business if that was to be the case?
So I view this as like game 4 of an NFL season. Okay, so it's really hard, to think about who's going into the Super Bowl, who's winning the Super Bowl when it's only the 4th week. So I think there's just too much to be decided. If you look back the first time, there was a lot of concern, apprehension that didn't necessarily materialize. So, but there's just a lot of data points to look at, who the running mate is, etc. He's proven to change his perspective, and so it's really hard to. In the 4th week of the season, to be placing too much conviction in anything.
There's a guy I've got a lot of respect for, Mark Dowd. He's in the market, and he always said back in 2016, it's really difficult to divorce your political bias from your market views. Yeah. When it came to 2016, I think the ultimate success, or at least the ultimate successful playbook, was just to try and divorce exactly that. Focus on the policy and don't focus on the volatility that comes with the man. Can you do that this time around?
Listen, always easier said than done.
Absolutely.
My guess is it's only the 4th week, and we're tired about hearing the scenario analysis played out. So my guess is a lot of these themes will be beaten. And then it's also, it's really unclear what the independents, which are the largest group that they've ever been in terms of the electoral body. So it's or the U.S. population. So I just think that it's really hard to focus until you're, I'm going to say, 60 days out, 90 days out.